Ladies and gentlemen, welcome to this discussion on one of the most exciting investment opportunities in today's global market. In this video, we'll dive into why China is emerging as a hotspot for savvy investors and how stocks like NIO are becoming the talk of the financial world. Whether you're an experienced investor or just starting, this is a trend you don't want to miss. Recently, there's been a noticeable buzz in the investment world as numerous prominent figures advocate for shifting focus toward China as a lucrative destination for investments. Big names like Dalio and David Tepper have emphasized the untapped potential within the Chinese market, particularly in assets and stocks. Their message is clear: China offers an exceptional opportunity to invest in undervalued stocks, and examples like NIO highlight this potential. Chinese equities, which have experienced significant declines, remain largely undervalued compared to their U.S. counterparts, which are often considered overpriced. Take U.S. stocks, for instance. Over the past year, they have seen substantial growth, leaving many of them overvalued by almost any standard. Some companies exhibit price-to-earnings P ratios that are almost unimaginable. A case in point is Tesla, which has displayed a P ratio exceeding 100. Numbers like these suggest that many U.S. stocks have surged far beyond reasonable valuations. For comparison, some of the biggest U.S. tech stocks show P ratios around 120 or higher. This scenario raises red flags for potential overvaluation and highlights the risks of investing at current price levels. Shifting back to China, the contrast becomes clear. Investors are beginning to recognize the immense potential Chinese stocks offer, especially given their current undervaluation. Recently, news emerged that Norway's $1.8 trillion wealth fund is seeking opportunities in China. This fund, one of the largest in the world, has expressed intentions to invest in Chinese stocks like NIO. Such a move signals a strong vote of confidence in the future of China's market and adds to the growing sentiment that the country presents unmatched opportunities. When I read about this development, I couldn't help but feel optimistic. The involvement of such a significant fund underscores a broader trend: global investors and financial powerhouses are beginning to shift their focus to China. For stocks like NIO, this could lead to a dramatic turnaround, with increased investment potentially triggering short squeezes and substantial price surges. Bloomberg's coverage of this trend confirms what many have been speculating. China's market recovery is on the horizon, and savvy investors are positioning themselves to benefit. One of the key factors driving this optimism is the Chinese government's proactive approach to stimulating economic growth. Recent announcements include plans to inject a staggering $1.4 trillion into the economy through stimulus measures. These initiatives aim to boost various sectors and ensure a strong recovery. Evidence of their impact is already visible. For example, December's GDP figures showed growth at 5.4%, surpassing the expected 5%. Such performance highlights that the economy is rebounding faster than anticipated, a trend that could further attract investment into Chinese equities. This combination of undervalued stocks and supportive government policies is hard to ignore. Unlike the U.S. market, where opportunities in growth or tech stocks are becoming scarce due to inflated valuations, Chinese equities are brimming with potential. Stocks like Alibaba, JD.com, Xpeng, Bilibili, and NIO are prime examples of companies poised for significant growth as the market recovers. Alibaba, for instance, has a P ratio of just 17.8, a level typically seen in value stocks rather than high-growth companies. Such figures underline the compelling opportunities available to investors willing to look beyond the U.S. Consider this. While companies like Palantir in the U.S. boast a P ratio of 388, Chinese stocks remain attractively priced. This disparity further illustrates why seasoned investors are turning their attention to China. The logic is simple. Investing in undervalued assets during a downturn positions one to benefit significantly when the market rebounds. For NIO and similar companies, this could mean dramatic price increases once the recovery gains momentum. Moreover, the influx of investment from global fund managers and billionaires is likely to create a ripple effect. As more money flows into the Chinese market, stocks like NIO could experience a snowball effect, leading to higher valuations and potential short squeezes. The current low trading prices of these stocks provide an incredible opportunity for early investors to capitalize on the anticipated recovery. It's worth noting that this sentiment isn't new. Visionaries like Dalio and David Tepper have consistently highlighted China's potential. Their endorsement of the Chinese market serves as a strong signal for investors worldwide. As these financial leaders advocate for investing in China, others are likely to follow suit, creating a wave of investment that could reshape the landscape for Chinese equities. In the context of the U.S. market, the picture is starkly different. Many growth and tech stocks have rallied to unsustainable levels, leaving little room for further gains. For instance, companies like Tesla and Palantir showcase extreme valuations that make it difficult to justify additional investment. On the other hand, China offers a haven for those seeking value and growth, with stocks trading at reasonable valuations and poised for a strong comeback. The potential for a short squeeze in Chinese stocks adds another layer of excitement. As large investors pour money into undervalued companies like NIO, the resulting surge in demand could drive prices upward rapidly. This scenario is particularly appealing to those who invest early, as the rewards could be substantial when the market begins to recover in earnest. Alibaba's valuation is another compelling example of the opportunities available in China. Despite being one of the most prominent companies in the country, its P ratio remains strikingly low compared to its U.S. counterparts. This discrepancy underscores the value hidden within Chinese equities and reinforces the idea that now is the time to act. Ultimately, the message is clear. China is emerging as a beacon of opportunity in a market environment where many other regions are struggling with overvaluation. As global funds and investors shift their focus to China, the stage is set for a significant recovery in Chinese stocks. For those willing to seize the moment, the rewards could be immense. Whether it's NIO, Alibaba, or other prominent Chinese companies, the potential for growth is undeniable. So, what's your take on this trend? Do you agree that now is the time to invest in Chinese equities? Let me know your thoughts, and let's prepare for what could be one of the most exciting market recoveries in recent history. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.